Today was a good day in the markets. No doubt about that. No arguing about it. NASDAQ did very well. Technology stocks led the charge today, as they have been here for a while. Small caps also doing well. Today, we did see a breakout of this consolidation pattern that we've been looking at here for a while. And we said on Friday that it was important for this market to break out of that consolidation so we could theoretically get a move here back towards old highs. And again, this is what we've been looking for. We talked about back over here that we were going to be adding some exposure to portfolios, which we did. We were still holding some extra cash here. Now with this breakout, we want to look to add some exposure. But hold on a second. Don't go clicking buy orders just yet, because just last week we saw this breakdown out of this consolidation pattern that lasted one day. The next day we were back up in that back into that consolidation pattern, hadn't really gone anywhere. So one day of a breakout doesn't really confirm anything. It's just one day. If we slip back below this, we have a sell-off tomorrow and the markets are down 15 or 20 points tomorrow, we're going to be back below this support level and back into that consolidation pattern. So again, a one-day move here, while good, doesn't really confirm that this is a breakout. We need to see a few days of action here, and this is why we look at markets on a weekly basis. So at the end of the week, we come back and look at the data for the week and see where we are to get some better confirmation. And what this does is that it eliminates these little head fakes that potentially trick us into making emotionally bad decisions because, whoops, we broke it, we broke support, got to get out. But see, if you're just patient for a couple of days, the market righted itself and actually increased from that level. So we're watching this very closely here. Again, this is very bullish action here. This is good. NASDAQ today doing very well. Technology is leading the charge. That's bullish. We're seeing participation in small caps. That's bullish. There's a lot of bullish action that's currently occurring within the market that suggests that the markets can indeed move higher from here. We just want to move into this very gradually. So we added some exposure here in the next day or so. If things continue to improve, we'll add some further positions we'll add to some of our current positions, add some new positions where we need to. We've continued to remove hedges that we had on back over here earlier this year. So the portfolios are actually working just really kind of more with the markets right now. But even with that being said, we're still cautious here because, again, we're moving into the summer months. We've got a lot of things that are going on economically that really aren't that friendly for the markets. Interest rates are going up. The Fed's going to be lifting interest rates to 2% on the middle of this month at their next meeting. We've got tariffs being imposed upon the economy by the administration. That's not economically friendly. And we're in a very late stage of this general market cycle. Valuations are high. We've talked about that. And the markets are very extended. So there's a lot of things to suggest there's still risk in the markets. And again, we're still within a consolidation pattern, even though it is improving here at the tail. And that we are getting a turn up here, which is bullish. But the markets really haven't gone a whole lot of anywhere since the beginning of January. So again, keeping this in mind, we do want to have exposure to the markets and participate, but we also want to be aware that things can change for the negative very quickly. So don't get overly excited. Don't be taking on an excessive amount of risk. We're in the summer months of the year, which tend to be weak. There's a lot of big events that are currently happening, not only domestically but globally, that could impact the financial markets. And again, we're watching interest rates move up at the same time that we've got the dollar moving higher. And one thing we'll be talking about tomorrow is that when you put into place this idea of trade tariffs, etc., in the backdrop of rising interest rates and the rising dollar all at the same time, that economically doesn't work out well, particularly when you have an economy, as we've talked about before, with really kind of stagnant growth overall. We're currently running about 2.5%. We may see a quarter here print in the next quarter, maybe closer to 2.5, 2.6%, but we're still within that real sluggish growth. We're not growing at 4 or 5% economic growth that can really offset the impact of higher interest rates, because as we've talked about before, higher interest rates impact the cost of what consumers deal with. When interest rates go up, when the Fed lifts interest rates, the prime rate's going to be going up, right? So Fed's going to hit about 2%. The prime rate's going to be 5%. That means that interest rates on credit cards are going up, variable rate debts are going up, subprime auto loans are going up, mortgage costs are going up. Mortgage loans are up a full point over last year, which means that if you're trying to buy a house, your house is substantially, that payment has gone up because interest rates have gone up by a full percentage point just since last year. So all these things impacted, and we're seeing some of the early anecdotal signs of higher rates. We're seeing credit card delinquencies going up. We're seeing charge-offs go up. We're seeing basically housing numbers begin to slow down as people are starting to pull back from buying houses because, again, interest rates are payments. People don't buy houses. They buy payments. People don't buy cars. They buy payments. Can you get me into that car? Yes, I can. How much is it going to cost me a month? $150. Great. How long do I have to finance it for? 12 years. But we'll get you in it, right? So, that's the society we live in. So don't dismiss the importance of rates. Interest rates are really, really important to the overall growth of the overall economy, and it's too readily dismissed across the mainstream media as to the impact of economic growth and ultimately the impact on corporate earnings and profitability down the road. And speaking of corporate profits, we are likely at the peak of profit growth. We're going to have very tough year-over-year comparisons starting the third quarter of this year. Expectations are still exceptionally high at this point for corporations to continue to grow earnings at double-digit growth rates of growth, which is going to be very challenging for them in the third quarter, fourth quarter, and first quarter of next year. So again, while things seem okay right now, while this is all very bullish at this point, and again, we're looking at adding exposure to portfolios, mind you, we also watch very carefully that downside risk. And when that downside risk begins to outweigh the potential for reward, we will be reducing exposure. The problem with a lot of buy and hold analysis is it tells you to get in, never tells you to get out. And that's where capital gets hurt the most. And by the way, we've started a new series on our website today. Every Monday, we're going to have a new chapter on our website regarding long-term investing and stock investing for the long run. We get requests all the time. It's like, do you have a guide over philosophy and about how things work in the markets? And the answer to this point has been no. But John Camarianos in studio with me tonight, myself, Michael Liebowitz, CFA, we are now putting that together. Over the next 14 or 15 weeks, we're going to be producing a guide each Monday at our website, realinvestmentadvice.com. And the best part about it is when we finish it, we'll turn it into a book for you. That'll all be at our website, Real Investment Advice. The first chapter is up right now, basically on long-term investing. At our website now, realinvestmentadvice.com. We'll be right back.